Good afternoon and welcome. We're so happy that you have taken the time to join us today. We want to thank Jerry Thomas, Brian Rugberg, and Danielle Clark, and all the management and decision analysts for inviting us to share our thoughts on the current market outlook and the impact on the stock market as well. My name is Julie Klein, your retirement plan service associate, and beside me are your financial advisors, John Arnott and Jerry Proder. Today, in today's 2023 outlook, we're going to briefly discuss inflation, recession, and planning for recovery. You're all currently muted, but at the end, we're going to take any questions that you want to type into the chat session during the presentation. So we'll read those at the end of the presentation. And right now, Jerry's going to kick us off with an inflation discussion.
So we're looking at inflation, and we've got two lines, the light blue and a gray, and we're dealing with headline consumer price index, CPI, and core CPI. Core CPI, which is the lower line, excludes food and energy prices. But most importantly, you can see that things are turning down, which simply means that the impact of the Fed interest increase has had a positive impact in lowering inflation. If you think about what we've been through in the last 24 to 36 months with the pandemic disruption meaning simply we shut everything down. Then we have a war between Russia and Ukraine, which certainly we know impacted the price of energy as well as food. And then we had an extremely high demand for housing, with people relocating, interest rates being very, very low, and inflation associated with that as well. So while high and rising inflation have caused significant pain for us, for consumers, we can see that going forward, we're going to have a lower level of inflation, regardless of which way the economy is going. We are anticipating some recession. And John, would you please tell us how these market cycles work?
All right. So as you can tell from this graph, and as everybody probably already knows, the economy does run in cycles, and we believe that most world economies are kind of on the downside slope of a recessionary climate, more or less. There's no doubt about it. Recessions are painful, but there are periods that we're having to go through in order to wash out some of the huge expansion that we've been through. And what causes it? Well, it's just part of the economic cycle, is going through ups and the downs. And so right now we're approaching what we think might be, and we hope will be, a mild recession after the pandemic and the widespread damage caused by having lower corporate profits, and a number of folks with rising unemployment. Consumers typically reduce spending, which further impedes economic growth. Company earnings go down and stock prices go down. So all of these factors are what we're seeing in this graph, where we can see even some of the countries on the bottom side of this graph are maybe even actually coming out of their recession, such as China and whatnot. So it's kind of a cleansing process, more or less, of getting through these things. And the result of that is what we tend to think of when we're looking at positioning 401ks and your other balances in this economy. How does that work? How does the stock market, how is that affected by the recessionary pricing?
So it's I don't know about strange, weird, or anything. You can see again a blue line and on orangish yellow line, and they don't intersect at the same places. The blue line is the stock market, and the yellow orange line is the economy. And the relationship between the market and the economy are different. And the stock market is a forward-looking process. Why? Because we, the analysts, are looking forward and saying, gee, interest rates are up, the economy's slowing down. We can see housing, automobile sales, things of that nature slowing down. We anticipate that the earnings of corporations, of the companies in the stock market, will go down, sales will go down. We see margins going down, meaning profitability. And so in a forward look, we're already in this, quote, recession that relates to stocks because we are down. And we hit some kind of a bottom last year at the end of the year. The economy at the same time is looking in arrears and saying we're going into anticipating recession. And so because stocks look forward and analysts look forward, stocks will usually lead us out of a recession earlier than the economy. And what it boils down to is when the economic news is far worse than expected, some investors respond by exiting markets, seeking safety in cash. But history has shown us that this often leads to missed opportunities because, again, stocks are often cheaper when the economy looks grim, creating opportunities for investors who are willing to look at the future is here. And these decisions are best made with a context, the context of careful planning, risk tolerance measurement, and financial planning. And this is what we're here to help you do and accomplish. So, John, being that we are looking at these markets, leading, lagging economies, how does that bode for how long do recessions last?
Well, this is one of my favorite slides right here, Jerry. The good news is that recessions generally aren't very long at all. Out of the last 11 cycles since 1950, recessions have lasted an average of 18 months. They're anywhere from 2 to 18 months. The average is 10 months. For those directly affected by a recession, they lose their job. Of course, it's a terrible thing. But as I said before, this is a natural occurrence. We wash out the bad and in comes the good. And as you can tell by this slide, the red triangles on the bottom are the recessionary periods. And of course, the blue is the growth periods. And we've just come out of one of the longest growth periods in the history. So this is 70 years. So the average recession is only 15% of the time. So 85% of the time we're in some type of growth period. We have an average of about a 25% gain in GDP. And whereas recessions, we lose about 2.5% of GDP. So equity returns can even be positive in the very final portions of any type of recession. And that's why I think one of the most important things that we can do is look at where to put you as an investor in the best position to come out of one of these recessions. And having said that, that's what we're going to talk about in the next slide, is how to get and position yourself to be in the right place. Jerry?
So as we have mentioned in the previous slides, stocks lead the recovery because in anticipation of a good tomorrow, stocks begin to rise. What's more, the stock market usually starts to recover months, 6 months before the recession ends. And stocks have already led the economy on the way down cycle, which was in the last year and a half. And then if we take a look at the trend right now, we're beginning to lead in an upward cycle. What's really interesting is that bull markets, the markets that continue to rise and go up, generally have an average return of 265%, while bear markets, the losing proposition, generally have a 33% loss. So riding through these recoveries way exceeds your returns and net value for your dollars. So it's a great time to not sit on the sidelines. Put your money to work. Make sure that if you need help, we've helped you with your asset allocation. If you've stopped making contributions, start making contributions again, or if you are making them, increase them. I think you will benefit from it in a going forward basis. And the way we deal with these things as well is through a diversified portfolio and asset allocation. And that's how we deal with the market. So, John, would you please share with us some of your thoughts on asset allocation?
Well, it's a two-pronged approach here. The chart that you see in front of you is everything from stocks to bonds and commodities and cash and everything in between. And the white box that flows through these 15 years kind of shows you that a diversified portfolio doesn't hit home runs, but it also doesn't lose each and every cycle. So it's a part of what we advocate is within the 401k, utilizing the target date funds to begin an asset allocation that creates a pretty even over the long haul rate of return for you. So by putting the same amount of money in every single month and dollar cost averaging in, you're buying more shares when the stock market's low, and you're buying fewer shares when the stock market's high. And the end result is that drives your break-even point down. And that's the important real advantage of investing in a 401k, is taking advantage of an asset allocation that gets you the right risk level. So you can be somebody that's about to retire and you're going to own more conservative investments. Somebody that's younger and putting more money in is going to be more aggressive in their investment cycle or investment allocation. And the result of that is, on average, what you see on this slide here. So performance is important, and over time, and fortunately for us, in the 401ks that we operate within, we're using the target date funds to get the most out of this type of asset allocation. And the results over time will prove to be very, very positive for most folks. So in summary, Julie.
I just want to summarize the key takeaways that John and Jerry just covered here, and that is that recessions are a necessary part of every business cycle. They have been relatively infrequent. They have been relatively short, and they have been less impactful compared with expansionary periods. So don't let how you feel about the economy overrule how you feel about investing, and try to maintain a balanced and broadly diversified portfolio. And I also want to encourage you to contact us if you want to have any type of review with your individual 401k account or with your other personal accounts, that we can maybe answer any questions that you have. I believe all of our information can be seen on this next slide or on our website at cobaltcravens.com. You can get all of our email addresses there. If you want to email us, we'll set up either a Zoom or an in-person or a conference call with you to get that scheduled. So now we'll look at any questions that you may have and see if we can continue a discussion. I've seen a couple of questions come through, seems to be a recurring theme as we were presenting this, that each day we hear on the news more and more about the banking crisis. And can you help summarize as far as what has happened, causing this crisis, and should we be worried about what we have in the bank and banks failing?
Well, one of the most interesting things that I've seen over the last 2 weeks is that the fact that we've lost a couple of banks that got a little sideways. This is what we were talking about earlier in our conversation in the slides, where we are eliminating some of the excesses. And so we saw out in California, SVB Bank had made investments in longer term bonds. And as interest rates go up, bond values go down. And as a result, when they needed to get cash to be able to pay some of their depositors, they were unable to meet all the demand. And I'm not sure many banks could have met the demand that was going on at that time. They would have had a very difficult time having $41 billion come out of their bank at any one time. So as a result, that bank had the FDIC step in, and the Federal Reserve also helped out, and all depositors were paid. The other bank was Signature Bank, and they got themselves into the same type of trouble, but it was with cryptocurrency. So these excesses, both in buying only longer term bonds and the fact that the other bank was buying cryptocurrency, has caused the bubble to explode. And so we've seen that ripple through not only the United States, but also the world. We've had a couple of other international banks. Jerry, you want to talk about that?
Well, I guess, first of all, just getting back to banks, the good news is that the Fed has stepped in. Depositors are not at risk. All the payroll monies got paid, and the restructure in a banking system, somewhat like the insurance system, when there are a few weak banks, the other stronger banks come in, between the FDIC backing up the failed assets, if any, and the banks that are coming in to take over. This system really continues and does well. So that's really an important aspect of what we have as a safety net for us in the banking system. The other part that's going to happen, is happening, is that with interest rates having gone as high as they have as quickly, the stress put on the economy and banks is going to slow down loans. It's going to slow down underwriting of money. And that also is going to contribute to reduce inflation and slow down the economy. So it's not just a factor of the Fed having to keep raising rates. We've already seen the impact and how that's going to help. What you referred to as far as a global crisis, it was really a triggering event for many things. And it usually takes something different every time we go through this type of a cycle.
What you mean, like housing crisis in 08?
And the 2000 bust and the bubble of the NASDAQ, where there was empty companies being valued at millions and trillions of dollars. Yep. So the global impact has obviously begun with COVID, with shutdowns in China, which just kind of rumbled right throughout the earth like a tidal wave. And then we have a war with Ukraine and Russia that has a huge impairment on dislocating energy and food. And then you combine that with going from a 0 interest rate economy to a 4.75% rate, and you see the impact of these things. So here again, we're at the tail end of the cycle, which I think is the good news. we're already in anticipation of the worst, so the good is about to come. And I'm very optimistic about the future. Any other questions?
That kind of summarizes, I guess, the one other question that I did see, Jerry, was that, can you help summarize the geopolitical, market disruptions and how they impact the US economy? Because we're not an island in and of ourselves, but that we keep having, geopolitical, international impacts on what is going on here and trying to recover our own economy.
Yeah, China is playing a big role with the kind of support they're giving Russia, almost encouraging the continuation of the war. But the geopolitical landscape is different simply because China is very, very dependent on the West for economic support. What economically China does with Russia is maybe a tenth of what they do with the Western world, which is the United States and Europe. China wants to grow their economy back at 5%. With all their shutdowns, they've had a recession. As John showed, they're down a lower cycle and trying to climb up. If they're going to climb out of it, they need us. So we need each other. This is a geopolitical thing.
That's good news too, because it's hard to have a war against your enemies if they're trying to climb out of a recession.
So we are in an environment that has some, quote, encouraging factors going on that hopefully as the year progresses and we reach some better understandings, things will improve again.
There's a question about rising interest rates affecting private equity and venture capital firms. Are they upside down because of rising interest rates? Maybe you want to repeat that too.
So the question is, do rising interest rates have an impact on private equity companies, smaller companies that are dependent on financing? And I would say that the answer is yes. The harder money is to get and the more expensive it is to get, the more you expect in return for that money. And companies that are not going to either be able to be turned around quickly or generate positive cash flows, whether they're in private equity or just small cap companies that are emerging, those are the companies that are struggling. Many private equity companies, though, have lots of cash. They have lots of money that they put in place, or at least got lines of credits and access to prior to this, and are still in very good condition to continue funding and continue operating.
But in this process, it also is going to reduce that inflationary cycle that we're talking about, because it is going to be a little bit harder to get financing for some of the new ones that are just now coming out, right?
Absolutely.
Yeah.
And that's part of this slowdown that we're anticipating.
So another question that's come up is there a fee for private consultations? And I believe maybe that is
There is
type
not.
of.
There is not. So what we offer to all of our 401k clients is that if you want to spend the time to be able to look at what's going on within your particular scenario, we're more than happy to set aside some time and devote the time that you need in order to get comfortable with what's happening inside your 401k. As a matter of fact, we do Zoom meetings all the time across the country, especially with your group, because you're so diversified in your with your employee base being all over the country. We're more than happy to schedule a Zoom call. If you'll give Julie a call or give us an email, and we'll be more than happy to send you out. I use something called Schedule Once now, so you can find time on your calendar and on mine that meets your all's needs. So there's another question.
Yes, a while back, companies like Walmart canceled inventory orders, which was unusual. Have those disruptions been worked through in the supply chain and retail? I don't know that they've been completely worked through, and if you think about it, this tidal wave, suppose that Walmart ordered winter clothes 9 months prior to winter. In other words, the lead time is that kind of lead time for them to have the inventory. We come into April, May, June, and China's shut down and we're not getting deliveries. And we come into October, November, and we're still not getting deliveries. And wow, lo and behold, those winter goods arrive in February. Well, you're canceling orders, but you still need orders. So you can't cancel a February order because it arrived. What happens in the system is this: even though we have a disruptive economic cycle, it was a disruption that was self-made and caused, meaning simply when you open things back up, you make them work again.
Well,
But digesting this right now means that the winter clothes move to a wholesaler.
oh, so TJ Maxx and Tuesday Morning and some of these other retailers end up with out of favor stock. And you as a consumer get to enjoy some potentially lower pricing.
In other words, inflation can be attacked in two different ways. One of it is for the price to go down, and the other one is for us to change our shopping habits. And both of those things are happening. So I find that I'm shopping for quote deals or sales in markets that have them, and I'm changing some of the food supplies and or things that I'm buying simply to wait until there's a time improves.
I think I saw some commentary even this morning about how the supply of the integral parts of the new Apple iPhones are 4 or 5 years ago were 60% made in China, and now they're 45% made in China. So the supply chains, we're kind of learning from our mistakes of relying on one supplier in one area. So we're kind of getting some diversification in our supply chain as well, which ultimately over time will help out. Now, the bad side of that is that if we're going to be doing manufacturing more domestically, it might cost a little bit more for that same product that we used to purchase, which is kind of inflationary, isn't it, Jerry?
It is, but that's good inflation. Full employment
Absolutely.
is good inflation. Why is inflation so worrisome? We just want to be able to keep our purchasing power accelerated or level in accordance with what we're buying.
Sure.
So that's the flip side that's very confusing. We have full employment. Yes, we see some layoffs being called by the big tech, the large companies. Nevertheless, we still have a lot of jobs to be filled. So these people seem to be finding jobs wherever they're looking. And those are all the kind of things, the signals that we see that call for either a very low, slow, little, tiny recession, or hardly any recession. So that yet has to be seen as this unfolds, whether unemployment does really go up or not.
Daphne, any other questions?
No other questions.
Well, I
Unless-
really thank everybody for tuning in. And as I said, if you'd like to schedule some time with us to review your 401k, send an email to Julie and she'll make sure that you get the schedule once that you can pop onto our calendars and take a look at when we're available. And as I routinely tell people, I've got the best job in the world and sometimes the worst job in the world, because I got to work when my clients, you want me to work, and sometimes that's when after hours, you know, it might be on a Saturday. So if you have some of those needs, give me a call and let's work through them. Happy to help any way we can. You agree, Jared?
Absolutely. Thank you again.
Thank you so much. And if you think of any other questions as you absorb the information we've covered, go ahead and email any one of us.
Thank you very much.
Thanks so much.
Have a good afternoon.
Thank you all very much. Appreciate it.
Thank you, Jared.
Have a great week.
Bye-bye.